Hey, and welcome to another video here at Fiscal Voyage. I'm Felix, and first off, want to make sure you guys are staying safe. Make sure you wash your hand during this pandemic, and stay 6 feet apart from one another. But most importantly, make sure you wash your hands. But with that, we're gonna do a 5-minute stock analysis on Realty Income Corp. This company is a monthly dividend payer, so you'll get basically a paycheck every month for owning shares of this company. And I personally own this company, and we're gonna find out if at today's prices, is it a buy, hold, or sell. So watch till the end of the video because I'm gonna provide you a fair value price. And then from there, we can make our buying or selling decision at that point. So let's get started. All right, here's the stock analysis on Realty Income Corp. You can find it in the New York Stock Exchange as O. The company is a REIT, which is a real estate investment trust that invests in freestanding single-tenant commercial properties in the U.S., Puerto Rico, and the United Kingdom, and that are subject to triple N leases. The company is organized in Maryland with its headquarters in San Diego, California. Some of the major tenants of the company is Walgreens, 7-Eleven, Dollar General, FedEx, and CVS. So that's interesting. Let's talk about that more later on. The company is one of the few real estate investment trusts that pays dividends monthly rather than quarterly like most companies, and has a registered trademark for the phrase the monthly dividend company, which is something I really love here. Fundamentals, the company grew revenue from 2010 to 2019, a 10-year period of 17.7%, which is outstanding. The last 5-year average is dropped quite considerably from that 17% to 9.9% with a revenue 5-year average. Net income from 10-year period grew at 14.3%, and that's kind of been steady, but also decreasing at 11.3% for the past 5-year average. They have a credit rating of A-, which is investment grade, which is good. Operating income for the 10-year period grew at 14.7%, and funds from operations, since it's a REIT, we don't look at earnings, we look at funds from operation. That grew at a 6.7% in that 10-year period, and has been dropping though for the past 5 years, been growing at 4.9%. If we continue with the fundamentals, last year the company had funds from operation of $3.32. Net margin came in at 29%, which is expanding from 2018, which came in at 27%, so that's a positive there. Return on equity 4.9, which has been consistent with its long-term average. Debt to cap is quite low at 45%, and currently the dividend yield is 5.6%. During the current market, there's companies that have a higher yield, but could be dangerous and not safe, those yields. But this is a nice high yield of 5.6, which is very safe in my opinion. We'll go ahead and talk about that more later. With a payout ratio of only 82%, which is low for a REIT. They are registered to required to pay out 90%, so this is still low compared to the 90% requirement. The company has a consecutive dividend year growth of 27 years, which is outstanding. I've owned this company for about 6 years, and it's like every other month they're increasing dividends, which is something I really enjoy. However, the growth rate is low at only 4.3% with the 5-year average growth rate. The most recent year-over-year increase was 3%. So they're kind of keeping up with inflation here, but in the higher side, so it's still good. And again, you're getting paid monthly. The 5-year dividend yield average is 4.23%. So currently, you can get the company at a higher yield versus the 5-year average. If we look at the future, analysts expect 2020 to come in at $3.42 for funds from operation, and 2021 $3.58. So analysts are expecting earnings to continue to grow even in this pandemic, because again, they have Walgreens, CVS, Home Depot, FedEx. A lot of these companies are still open when a lot of others are closed during this pandemic. So that's something very positive here. CFRA has a projected FFO compound annually growth rate for the next 3 years at 5%. I can't do the dividend drill return model because it's a REIT, so it's kind of difficult there to use this model. However, currently the price for the company has a price over FFO of 14.9 versus the 5-year average of 19. So based on this, it's undervalued. If we look at a fast graph, the black line is the monthly closing price, the orange is the FFO of a multiple of 15, and the blue line is the normal PE. So you can see the company tends to be more or less in the normal PE range of 19. I would say maybe 18. But currently at a price over FFO of 14.9 is barely fairly valued based on this graph. But if we look at a fair value prices here, CFRI has a fair value of 48, Morningstar is 65, FastGraph at 63 based on the normal PE of 19, Yahoo at 64, and my dividend discount model analysis at 48. If we average out the 5, we get a fair price of 57. And currently at today's price, the company goes for $50.75. So that means the company is undervalued by 13.7%, and that gives us a safe margin of the 10% that I like to look at or see when I do these fair value calculations. So with that, I have a buying recommendation for the company. The company is a monthly dividend payer, so which is something I really enjoy, and I love seeing those payments every month. They increase the dividends every other month, it seems, but it's very minimum, like a 0.3%, 0.5%, but year over year, they average about 3% to 4% growth. So it's just over inflation. The most important thing is that since it's a REIT and a lot of companies are closed and a lot of companies are unable to pay rents, that's something that's really bright here in retail income corporation here, because a lot of the tenants are Walgreens, 7-Eleven, Dollar General, FedEx, CVS, Home Depot. All these companies are still open and open for business, so they're able to pay rent. So this company looks very safe at current price and during the pandemic. So like I said, not much not to like besides the dividend growth, which is in the low end, but it's still great. That's why I have a buy recommendation. I own this company currently, and I wouldn't mind buying shares at current price if I had extra money to pay buy shares. But with that, thank you for watching. If you have a company that you would like to see next, please leave the name of the company and ticker symbol in the comments. Thanks for watching, and if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And don't forget to check out my portfolio. There's a link in the description below. Thanks again, and stay safe, and make sure you guys wash your hands. Thanks.